Interest rates aren't just for economists. They affect every part of our financial lives, whether we realize it or not. From the moment you take out a loan to buy a car, swipe your credit card at the store, or even stash money in a savings account, interest rates are quietly shaping your financial future. When rates rise, borrowing for things like homes, cars, or even using credit cards gets pricier. That means monthly payments can go up, and you might have to think twice before making big purchases. On the flip side, when rates fall, loans become cheaper, freeing up cash for other goals, like saving for a vacation or investing in your future. The Federal Reserve, or Fed, uses interest rates as a powerful tool to keep inflation in check and support employment. Their decisions ripple through the entire economy, influencing everything from the cost of groceries to the strength of the job market. Their decisions impact your savings, mortgage payments, and even job security. A small change in rates can mean hundreds or thousands of dollars over the life of a loan, and can affect how much you earn on your savings. By understanding interest rate trends, you can make smarter choices about saving, investing, and spending. It's not just about numbers, it's about making your money work for you, no matter your age or financial goals. The Fed raises rates to cool off inflation and lowers them to boost a sluggish economy. These moves are designed to keep the economy balanced, but they also affect your day-to-day life in ways you might not expect. As we move into 2026, talk of possible rate cuts isn't just financial jargon, it's about your wallet and your future. Every rate change can influence your ability to save, spend, and invest wisely. Knowing why rates change helps you plan for big purchases, retirement, and everyday expenses. It empowers you to make informed decisions, whether you're buying a home, planning for college, or simply managing your monthly bills. Let's break down what UBS, one of the world's biggest financial institutions, predicts for the year ahead. Their insights can help you anticipate changes and adjust your financial strategy accordingly. Understanding these shifts can help you stay ahead financially, giving you the confidence to navigate whatever the economy throws your way. UBS, a major player in global finance, is closely watching the Federal Reserve's next moves. According to their latest outlook, UBS predicts the Fed will cut its key interest rate twice before the end of this year. A significant shift after a long period of higher rates. They expect 2 cuts of 0.25% each, most likely happening between June and September 2026. These months are seen as pivotal, as the Fed could respond to changing economic signals and adjust its policy accordingly. Even small rate changes can ripple through the economy, affecting everything from the cost of borrowing for homes and cars to the returns on savings and investments. Businesses may find it easier to finance growth, while consumers could see lower interest rates on loans and credit cards. UBS's forecast signals a shift. After years of the Fed fighting high inflation with aggressive rate hikes, there's now a real possibility that the central bank may soon ease up and start supporting growth again. Lower rates could boost stock prices, make existing bonds more valuable, and even lift gold prices as investors look for new opportunities. The effects could be felt across global markets, influencing everything from retirement accounts to commodity prices. This isn't just speculation. UBS bases its call on careful analysis of current economic trends, including inflation, employment, and global growth. Their team of experts reviews a wide range of data before making these predictions. While nothing is ever certain in the world of finance, understanding UBS's reasoning gives you a clearer view of what might come next and helps you prepare for possible changes. These predictions aren't just for big investors. Everyday savers and families can use this information to make smarter decisions about their money, from planning for retirement to managing debt. The economic landscape is always changing, and staying informed about expert forecasts puts you in a stronger position to adapt and thrive, no matter what the future holds. Next, let's take a closer look at the inflation data that's driving these forecasts and shaping the outlook for the months ahead. The latest inflation numbers are at the heart of UBS's prediction. and they're sending important signals to both policymakers and everyday consumers. Understanding these numbers is crucial for anyone trying to make sense of where the economy is headed next. In January 2026, the Consumer Price Index, or CPI, rose just 2.4% year-over-year, bringing it much closer to the Federal Reserve's long-standing 2% target. This is a significant development, as it marks a clear shift from the higher inflation rates we saw in previous years. This cooling trend in inflation suggests that the Fed's earlier series of aggressive rate hikes are finally having the intended effect, slowing down price increases across a wide range of goods and services. It's a sign that monetary policy is working as planned. Before this latest report, strong job numbers and a resilient labor market led many experts to believe that interest rate cuts were still a long way off, as the economy seemed to be running hot. But now, with softer inflation data coming in, expectations have shifted. Many analysts and investors are starting to see a mid-year rate cut as a real possibility, which could have ripple effects throughout the economy. Every new economic report, whether it's about jobs, consumer spending, or prices, adds another piece to the puzzle, helping experts and the public alike build a clearer picture of the economic landscape. The recent CPI reading gives the Federal Reserve more concrete evidence that inflation is moderating, which is exactly what they've been hoping to see after months of uncertainty. For UBS, this data forms the foundation for their forecast. They believe the environment is finally right for a policy shift, and that the Fed may soon have the confidence to adjust its approach. Watching these numbers closely can help you anticipate changes that could affect your finances, from mortgage rates to the cost of everyday goods. Staying informed is more important than ever. Now let's explore the concept of disinflation, what it means, how it's different from deflation, and why understanding this trend matters for everyone. UBS analysts highlight a key trend: disinflation, or a slowdown in the pace of price increases. Unlike deflation, which is falling prices and can hurt the economy, disinflation means prices are still rising, just more slowly. A big driver is shelter costs, rents and housing, which are finally cooling off after years of rapid increases. Since shelter is a major part of the inflation basket, this shift has a big impact on overall numbers. Consistent disinflation gives the Fed confidence that inflation is under control. This trend allows policymakers to consider rate cuts without risking a surge in prices. The goal: bring inflation down gently, without triggering a recession. Disinflation is the green light UBS and others have been waiting for. To predict the Fed's next move, look at what they've done recently. In January 2026, the Fed paused rate changes, holding steady after a series of cuts in 2025. This wait-and-see approach lets them gauge the impact of earlier moves. By pausing, the Fed signaled cautious optimism, tight enough to fight inflation, but not so tight as to stall growth. The strong jobs report raised concerns, but cooling inflation balanced the outlook. The Fed is now data-dependent, watching each report closely. If inflation keeps moderating, the next logical step is a rate cut. The pause marks a shift from aggressive action to careful normalization. UBS and others see this as a clear sign. Cuts are likely on the horizon. The people leading the Fed matter as much as the data. Vice Chair Philip Jefferson expects disinflation to continue, thanks to rising productivity. Productivity growth lets the economy expand without fueling inflation, supporting the case for lower rates. Surveys show consumers expect inflation to ease, another positive sign. Leadership changes could also matter. Kevin Warsh, nominated as the next Fed chair, favors a looser policy. A more dovish Fed, one that prefers lower rates, could accelerate cuts. The combination of supportive data and leadership makes rate cuts in 2026 even more likely. Policy isn't just about numbers, it's about the people interpreting them. When the Fed cuts rates, the effects hit home fast. Lower rates mean cheaper mortgages, auto loans, and personal loans, making big purchases more affordable. Even a small drop in your mortgage rate can save you thousands over time. If you have variable rate debt, your payments could go down, easing your monthly budget. On the flip side, savers may earn less on bank accounts and CDs. Lower rates often boost the stock market, as companies can borrow more cheaply to grow. Your 401k or investment accounts could benefit, but remember, markets are unpredictable. Retirees relying on interest income may need to adjust. Every rate move has winners and losers. Knowing where you stand helps you plan. Understanding these impacts lets you make smarter financial choices. Let's talk about how to prepare for a changing rate environment. With rate cuts possible, now's the time to get proactive. Consider consolidating high-interest debt or refinancing your mortgage if rates drop. If you're house hunting, falling rates could boost your buying power. Get your finances ready. Keep your emergency fund strong, even if savings rates dip. Don't overhaul your investments based on short-term predictions. Stay diversified. Consult a financial advisor to fine-tune your strategy for a lower-rate world. Focus on habits you can control. Automate savings, stick to your budget, and review your goals. Smart, steady moves now can set you up for long-term success. Understanding interest rates and economic trends isn't just for experts. It's for anyone who wants to take charge of their money. Staying informed helps you make better decisions, from mortgages to investments. You don't need to follow the markets daily, but regular updates build your financial confidence. Each new concept you learn is a tool for smarter choices. Financial education is a lifelong journey. Keep asking questions and seeking reliable information. The more you know, the better you can navigate change and opportunity. Invest in your financial knowledge. It pays off for life. If you found this helpful, subscribe for more practical finance lessons.